Hi, everyone. Today, let's go over Fundrise's Q3 2022 investor letter. I'll quickly go over just a little bit about my account, and that'll be it for this video. If you want to know more about my account or my quarterly returns, definitely check out my last video, which is linked above. Otherwise, definitely like and subscribe, and hit the bell so you don't miss out on any future videos. Welcome to the Portfolio Bulletin. Let's get started. So starting off with the investor letter, they say the third quarter ended up pretty much as they expected and what they put out in their mid-year letter. Higher rates have caused growth to slow down, and despite an attempted recovery, the stock market continues to be down 24% year to date, and public REITs have ended up even worse at 28% down through the end of Q3. They say, in contrast, Fundrise has continued to be extremely resilient, with average returns for Q3 a positive 0.09%, with year-to-date returns of 9.4% on average, outperforming the stock market by approximately 30%. These are some of the things I did lay out previously, but they put it all in one place here in detail for you. So dividend returns for Fundrise, 1.67%, all public REITs, 1.85%, and the stock market at 0.9%. And then on appreciation, that's where they really outperformed, 3.73%, minus 30% here for public REITs, and minus almost 25% here for the stock market. And then you have the nets down here with dividends and appreciation, so minus 28% for public REITs and minus just below 24% here for the stock market, and a positive 5.4% here for Fundrise. They say despite the fact that public markets have rallied a little bit here and there, the trend continues down, and they see growth slowing, borrowing costs rising, and job losses mounting in the future, as well as asset values declining. They think a recession will start sometime next year, which is the general consensus across the markets right now, and is pretty common after we have a Fed hiking cycle. Which is what they say here. The Fed is going to induce a recession, years in the making, and they view it as their responsibility to take care of their investors and put them in the best position for a range of scenarios. Today, they are in a scenario which has concerned them for years, which would be a great deleveraging, which is generally inevitable from 10 years plus of accommodative monetary policy after the great financial crisis in 2008. So they've been paranoid about this and that risk since 2017, and they sent that letter to everybody on the platform. And they talk a little bit about inflation here. They said the Fed needs to increase its interest rates to make people feel poorer. This is known as the wealth effect. As interest rates go up, people tend to feel poorer and they will spend less money as things get more and more expensive. That will cause investors to think more about how much money they're going to lose versus how much they are going to make. In terms of Fundrise and the real economy, say that their portfolio is going to hold up strong, not because they think it's immune to microeconomic shockwaves. Instead, they are confident in the portfolio that they have built within Fundrise, and they derive their value from people's everyday lives. Renting houses is one of the foundations of their portfolio because it is a basic necessity, meaning that if people cut their spending on other things, such as entertainment, new cars, or eating out, they still have to spend money on their rent. And that's one of the costs that's historically kept up with inflation, making the housing markets one of the few investments potentially able to hold its value during a period like this. Another thing worth mentioning here is as the price of homes stays high and gets higher with interest rates, it's going to be more valuable to the consumer to rent the house. You can see they have the potential rate of rent, which is quite a bit lower than what it would cost to get that mortgage payment on a new home in the United States. So average rent versus average mortgage payment. They also go over some of the things here around the fact that house values are going down. It's not quite the same as 2008. What they say here is that some of the results of over-leveraging and oversupply, whereas the house market now is under-levered and undersupplied. Mortgage rating standards over the past decades have seen a significant tightening, with higher credit scores required to give equity to borrowers, and more equity is required from borrowers to get those same loans. As a result, we are in a better position than we were in 2008, especially in the housing market. They also say that the housing market has benefited from COVID because a lot of millennials are not working in buildings right now. They're actually working from home. And about $500 billion have moved from office buildings into home property values, which caused a really strong 60% appreciation in home values. And in summary, they're not saying that this is going to last forever, and they might fall in the short run, but certainly not as far as they did in 2008, and they still think this is a good asset to invest in, as rents continue to be very competitive versus mortgages. Going into the future, they say that the Fundrise portfolio is not immune to any pain. If the Fed continues to raise rates, it is inevitable that there will be declines in asset classes, and this can result in temporary write-downs in terms of value, at least on paper. And I definitely experienced some of those. We'll talk about that a little bit later. But they say that they expect their performance to be better than anything comparable. They do say that they expect a downturn in the economy, at least in the near term, and that it's not going to be fun for anybody. And they say they are starting to understand the rules of the game and that the helicopter money or that cheap free money that we've been experiencing is coming to an end, and that there's a lot of things that are going to come crashing down, like dog coins or flying cars. I don't know about flying cars here. I think that's probably going to be a thing, but I understand the dog coin reference. Once again, they say they expect to deliver strong results as the market continues to struggle over the next 6 to 9 months, which will continue to get worse in their opinion. They are starting to look ahead to an eventual bottom and a final tipping towards cautious optimism. And then they thank all of their investors for sticking with them and focus on that long-term outcome. I just want to double back quickly to highlight this. This is the big takeaway here. Fundrise continues to outperform and be a stalwart in my portfolio as the markets continue to downtrend and suck this year. I appreciate having this really strong asset in my overall portfolio. And definitely check out Fundrise if you're not already an investor and use the link in the description to get yourself $50 free with Fundrise. Again, going over my performance, I did go over this in detail last time, but I want to highlight we did have a couple of losing quarters. We did have a couple of losing quarters in some REITs, and just a small loser here in these two REITs. My total year to date is above the average at 6.1% already for Fundrise, and still much, much higher than public REITs or the overall stock market. Then we can change that to dollars here, and you can see that net gain is $2,600, pretty strong in this portfolio. Finally, here I did want to mention my Q3 returns in terms of dividends. Got $147.03, and I did reinvest that right back into this portfolio for the long term. Again, definitely check out Fundrise. They have a lot of great tools and a lot of different funds for every type of investor. Definitely like and subscribe if you got any value out of this video. Comment down below what you think of Fundrise and how it compares to your other assets. And where is Fundrise in your portfolio? Is it a stronger asset or is it something you're just dabbling in? Make sure you comment anything you'd like me to cover in the future. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your investing and have a great day.